Brian, when you're considering investing in real estate, you really have to consider sectors. Can you expand on that?
Yeah, I think this would fall in the passive investment real estate area more than active, because a lot of people that have real estate own single family rental houses. They don't own casinos, they don't own apartment buildings, some do, but most people that I talk to start with either maybe their office building where they worked, or rental houses, or maybe a mobile home park, duplex, eightplex, that kind of thing. Now, for people that want to do 1031 exchanges into Delaware statutory trusts, now you have a plethora of different kinds of sectors of real estate to consider. And so that's what I wanted to talk about in this segment, was what are some of the attributes of some of the different sectors of real estate.
Okay, Brian, so you talked about sectors. What are the individual sectors that we're considering here?
Yeah, so the first one is the rental house sector, and that's what you're probably coming from. There are REITs out there that own rental houses, so some of the attributes of that is that they probably have a lot more appreciation potential than most real estate sectors. And if you own one rental house, you have tenant risk, but if you're part of a group of many rental houses, you really don't have that. So that can be a big advantage for that. I've never seen a rental house DST, though, I will say that. I have seen that with a real estate investment trust. Now, with multifamily or apartment buildings, that's a different class. Again, it has a really higher upside, but if you're in the wrong part of the country at the wrong time, you can lose money on them too. If you're, maybe you don't have, you bought an older one, it had a lot of repairs. We've seen what's happened with Miami apartments lately. Most apartments in DSTs and REITs are newer, so they don't have those kinds of issues. But certainly location with multifamily. And one of the risks to multifamily is I've seen a situation where they built them in a growing city, but everybody else had the same idea, and you see 7 other apartment buildings go up within 3 blocks, and now they're all struggling to find enough tenants. So there can be some issues with that, but generally speaking, multifamily, if you have it in the right part of the country, the right location, the right demographic, the right city block even, can be very good. Another area is industrial parks. They're very popular since COVID. One of the detriments, though, to industrial parks is they don't pay a lot of yield typically because they're so steady eddy. Think of an Amazon lease. I mean, most of the time investors are willing to get 3% on an Amazon lease. So they're not going to get a lot of money. They're never going to see an increase in rents. So you're not going to see a lot of appreciation probably in that kind of investment, but it can be, again, more steady eddy. Other areas are healthcare facilities. You have a little more tenant risk there. Casinos, interestingly enough, can be a big area. Self-storage, we're the only country on the planet that has self-storage as an asset class. What I found interesting about that is during COVID, people were staying in their apartments but not paying rent sometimes, and having the rent excused. But they were all paying their self-storage rent because they knew if they missed a payment there, they got their stuff thrown out or sold, and they would lose their stuff. So everybody made their self-storage payments even if they couldn't make the rent payment. And finally, multifamily, where manufactured housing, just the lots, not the structures on them. That can be another area, or one more, net lease properties, where like 7-Elevens or Walgreens or that kind of thing, where you have a tenant like that. So each of these different sectors of real estate have different attributes, positive and negative, and it's very difficult to find people that understand the nuances of that, but you really should understand the nuances before you invest in a REIT or a Delaware statutory trust.
So the basic sectors are commercial and residential, then there are subsectors under those. Let's talk about some of the detriments of investing in these individual sectors.
Yeah, so as let's say we're doing a DST and we're picking different ones. Some are going to have more potential appreciation, which means they have more downside risks. Some are going to have better cash flow, but no potential appreciation. So we always have to balance that. So that's one of the good things we can do in the financial planning process, is once we determine that DST or REIT is appropriate for you, then we can determine which is more important, potential growth, liquidity, cash flow, risk tolerance. What part of the country do you like? I've had people tell me that, gee, I don't want to invest in Florida. They have hurricanes. I said, well, they have insurance. No, I still don't want that. I said, how about Denver? They don't have hurricanes there. I said, yeah, I like Denver, or whatever. So depending on the person, they might say, gee, I like this or don't like that. And that's okay, too, to have your individual preferences.
So what are the advantages of each individual sector, though?
Oh, yeah, that can be dramatic. I'd say over the last 30 years, real estate has been one of the highest performing stock market sectors as you compare it to other stock market sectors of all of them. In fact, I think next to technology, it might be the highest performing sector over the last 30 years. So real estate can and should, for most people, be a component of their investment portfolio. It's done quite well. It's not correlated to the market that closely. When the market collapses or goes way up, it doesn't really follow suit necessarily. Real estate can be advantageous in an inflationary market because they might own fixed rate loans, but as inflation hits, rents go up, but the payouts stay constant, so we don't have, we have an increase in bottom line. They tend to have the best cash flow of anything out there in the stock market. Most stock market sectors do not pay the cash flow that real estate does. So I think real estate can be a very important component to most financial plans, whether it's in the DST world or just REITs, whether through your qualified or non-qualified investment accounts. But you can get a vast array of different sectors and spread your risk out. Diversifying amongst real estate, get that nice cash flow, maybe some really good appreciation, some downside risk when the market's really volatile. So there can be a lot of advantages to owning passive real estate.
Can you give me an example of a client that you've helped deciding on what real estate sector to go into?
Yeah, so when it comes to DSTs, we're limited, so I'll do maybe Delaware Statutory Trust analysis for somebody that's doing a 1031 exchange. And there might be a limit on what's available at any given time. So we're always trying to get a good mix. So let's say somebody has a $1 million sale of investment real estate. We might try and find 3, 4, 5 different DSTs to put them into. So that we can get some diversification there. Now, if it's your IRA account, maybe a 401k rollover, we can pretty much get into most any kind of investment real estate sector we want. So often I like to have a mix. So I remember recently I did that for somebody that had both qualified and non-qualified money. We got into a fund with over 10,000 rental houses, another one with 1,500 properties, apartment buildings across the southern states, casinos, industrial parks. We got another one with manufactured housing. So literally we had 10 to 20,000 properties, all kinds of diversity, all the different growing states represented, really good cash flow and so forth, and they didn't have to lift a finger and never will. They'll never get a phone call or anything. They get their monthly rent checks or quarterly rent checks from these investments, as well as the underlying appreciation of the real estate. Now, real estate can go down in value, so it's not, it doesn't always go up. It has been pretty much for 10 years, but that can be a really good asset class for folks.
Great information, Brian. Thanks so much for your expertise.